Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach. Today we have with us David Bruce, who's the COO of Accelerated Banking. David, welcome to the program.
I'm glad to be here, Mike. Thanks for having me.
You're welcome. So give us a little bit of your background. What is your story and how did you get into this industry?
Well, I have been in mortgage lending for almost 30 years. And several years ago, I learned about these cash flow strategies, which are now known as accelerated banking. And it really caught me off guard. I was like, wow, being in the industry, how did I not know this? So I learned more about the strategy and got to the point to where I really believe so much in the strategy that I closed my mortgage company because I wanted to quit putting people into 30-year debt traps and help teach people how to use home equity lines of credit, and cash flow strategies to be able to be much more efficient and pay off their home faster and really just change the way that the banking relationship works in order to be able to be more efficient. So that led to me dedicating the rest of my career through education, consultation, and helping families become aware through really awareness that there may be a better way for them than a mortgage.
I like how you said 30-year death trap because it made me think of something that I learned many years ago. Do you know what the Latin derivative of the word mortgage is?
Absolutely. Yes. Death pledge.
Yep. I've heard it said death grip, but death grip, death pledge, 30-year debt trap. And then it kind of gets into even also how people use a mortgage. And I know that you can get into this as we talk, but I spent about 12 years in the mortgage industry back in the late 90s and into early 2000 before the whole crash. And then I got out and it was like done because that crash just, hit you in the gut. But one thing I do remember is you would have someone that gets a house, gets that 30-year fixed rate mortgage. Then a handful of years later, they come back and, let's pay off some credit cards and let's get another 30-year. And then a few years later, come back and it's like 30 or 30 or 30, and you never get done. And it's like you're 45 years old, 10, 15, 17 years into your, living in your house, not maybe the same one, but you've never made any ground. So do you see that in working with clients that you work with?
Absolutely. And that's one of the things that we want to educate families about is the pitfalls and the traps that come with that amortized mortgage. And that is the fact that, people really don't buy houses nowadays based on the purchase price. They buy it based on the monthly payment that they can afford. And, they may buy the house and they can afford that payment. And then a couple of years later, they're 2 years into their loan and the interest rates have dropped a little bit. And they make the mistake of chasing the interest rate and refinancing for a slightly lower rate, but they start all over at 30 years all over again. And then they turn around and start that amortization schedule, all that front-loaded interest at the very beginning.
Yep.
And then maybe they stay in that home for a few more years and decide to move. And then they go buy another house. And now they start over at 30 years. And then they turn around and decide they want to do some home improvements and borrow money against it and start over at 30 years. So we've seen people go through that cycle repetitively. And I have to admit, early in my career, I did it. I didn't know any better.
Yep.
I chased the interest rate. I cashed out. I consolidated. I did some of the things that people do. But once I come to learn that is not the yardstick, that's not the way that we should be thinking about it. It really changed the way that I think about it for myself and my family. And then I said, well, hold on. If I'm doing this for my family, why wouldn't I want to educate people so they could do it for theirs as well?
I think it really is interesting that you mentioned what you chase or you focus on, because one of the other factors that goes into all of those little, hot points that you mentioned, you refinance here and cash out there and home improvement there, is a big old chunk of fees. And even if it's a fair amount, like even if you're working with a mortgage lender that is fair and not loading it up, there are still thousands of dollars added in for just regular old title and closing cost and processing and appraisal, all of that stuff. So you're getting that, you're taking away the 2 to 3 to 4 years you've been paying on that 30-year, getting a new one, so going backwards, and then adding fees and going backwards. And you rolled in some credit card debt or whatever that you're paying off, and that all of a sudden, the underlying to that is like if you had a cut on your arm and it severed an artery and you just put a Band-Aid on it. Well, it's not treating the root cause. So talk a little bit about what you see as the root cause, because I will propose to you that it's misspending, misuse of money, misuse of interest, misuse of credit. You have to get that fixed, and then you can put in a good vehicle to help you accelerate all that.
Right. You're absolutely right. And it really comes down to the heartbeat of our strategy is about cash flow management, which means you have to have a budget. And you have to know what money you have coming into your budget each month. You have to know what your expenses are each month. And you've got to live within your means. You can't be spending more and going into credit card debt and seeing that I'm negative $10,000 this year because now I spent more than I made. Our strategy isn't about asking people to change their lifestyles, but what it's about is being able to be responsible to yourself by starting with a budget and knowing that that's where all of your financial future is going to start.
Yeah. Well, I think that's a big piece, because first of all, you need, you don't know what you don't know. So you need to, be educated on that. And then you need to know your own limitations, because if someone gives you a big old account and says, dump everything in this, and then you can just access it, that's not the same thing as, oops, I went over on my credit card this month. That's like a major asset, your house. So what are you helping your clients understand as far as making sure they're dialed into that, sticking to that budget?
Well, the main thing being is that it's about the budget, and it's about understanding that in order to pay a home off faster and pay less interest along the way throughout that process, it's all about efficiency. It's all about the cash flow management, and it's all about personal responsibility. So, as an example, like you just said, if somebody has a big home equity line of credit with money that's available to them, if they don't have that personal discipline, that could become dangerous.
Yes.
Because if they're not using it and using strategies and using it wisely in order to change the way that interest is calculated, in order to be more efficient, to pay off faster, and they just use it as a piggy bank, this year it's a boat, next year it's a new car, the year after that it's an RV, or it's a vacation, or it's this, or it's that. And the next thing you know, you've consumed your equity instead of built equity, because you're not thinking about it properly. So for some people, if they don't have the ability to know themselves, which I have had people tell me, I know myself well enough that I better not have access to my equity because I will spend it.
And if that's the case,
you have to know
then
yourself,
good job.
and you have to know.
Yeah, if that is the case, then good. You know yourself, and you're going to not put yourself in that situation. So I think that's huge. So let's now roll into what is accelerated banking. How does it look? How does it work? And for the people that are understanding it and disciplined and want to move forward, what all does that look like?
So accelerated banking is the process of taking control of your cash flow. And what I mean by that is when most of us get paid, say you get your paycheck today, what are you going to do with it? You're going to deposit it into a checking account, maybe let some money sit in a savings account. Well, what do the banks pay for that? They pay very little, which means that you're basically giving them a free loan, or virtually a free loan each night that your money sits in the bank. So what we're wanting to do is we're wanting to change that process, and we're wanting to finance our home with an open-ended, simple interest home equity line of credit, because that allows us now to treat that line of credit as the checking account, as the savings account. And now what we're doing is we're doing what's called offset accounting. We're offsetting our balance to avoid interest. So the heart of our strategy is doing the things that we can do with our cash flow to minimize the daily balance so that we could avoid interest all the way down to the daily level. And if we can avoid paying some interest today, that means money goes to principal faster. And the faster we could reduce the principal, the less interest you could be charged. And so the faster that you could reduce the balance, the less interest you're going to pay over the life of the loan. And then the other piece of it that comes with it comes with the security of knowing that you do have access to that equity, that you can take money and spend money just like you do out of a checking or savings account. But you want to use that home equity line of credit as a parking lot for your checking and savings so that you can avoid the interest until you need it, until you need those funds.
That's an interesting point right there. So I want to touch on a couple things. One is if someone is making enough monthly cash flow that they can just put, let's just say, triple monthly payments, double or triple, and they're just cranking down and paying principal because they heard if you paid more than your regular payment, all that goes to interest and it really helps pay the loan down. And that is true. But what if 1 to 2 to 3 years down the road, you're just cranking down payment, and you've got half your house paid off and then you need money? Well, you can't just, go to the bank and go, oh, I've been paying extra, so I'm going to just not pay for the next 6 to 7 months. That doesn't work. And you can't go to the bank and go, hey, can you slip me back 10 grand that I've been paying you? That doesn't work. You've got to apply to hopefully, maybe, possibly get some of that money. So the liquidity that you just mentioned is a huge piece, because if you're making all those extra payments, but it's in a first mortgage home equity line of credit, you can easily reaccess it with a check.
Right, absolutely, and the access and liquidity is so important because, like you just mentioned, if you're making extra payments to an amortized mortgage, that money becomes trapped. You can't get it out. And one of the golden rules of the banks is that they really don't want to give you money when you need it the most. They want to lend money to people that really don't need money. So if you're unemployed, you got hurt, you lost your job, you don't have any cash, and all your equity is sitting there, you don't have access to it. That's not the bank's problem. They don't care. Yep. You either go through their underwriting and meet their criteria or you don't. Yeah. And they will have no problem foreclosing on somebody that has a $50,000 balance on $1 million property.
Yeah.
If you don't pay, they will do that.
Yeah.
So you never want to have all that equity just sitting there trapped because, number one, it's lazy equity. It's not doing anything for you. Number two, you don't have access to it when you need it the most. Hopefully you don't need it, but if you do, for emergencies per se, it's there. It's also opportunity. It's also down payment money for an investment property to create a new income stream. It's money to start a business. It's money that can be used intelligently to create new cash flow streams, not just access to equity that's used for consumption.
Now, let's say that someone, they pull up their budget and here's this Excel file and you're looking at it with them. And at the end of every month, they've got, I don't know, let's just call it $50 left over. It's like, okay, we're paying our bills, but barely, right? Now, what I'm about to say, I know your program is not this, but I remember way back in the day, like so long ago, it's embarrassing. The concept of biweekly payments. You would get people set up on just pay every 2 weeks and every 2 weeks, literally. And then every so often, by the end of the year, you've got an extra full payment, and it was just kind of like a little thing or gimmicks to, in reality, all you got to do is go to the end of the year, make your regular payments, and then just send the mortgage company one extra full payment. Same difference. But where I'm going with it is this: it's paying extra on your mortgage so it goes to principal, not all interest. But what do you do with someone that only has a very small amount of monthly cash flow left over? How does this benefit them?
The simple answer is, unfortunately, it will not benefit them. And the reason being is because this is a cash flow strategy, and it is about being able to reduce the balance rapidly. So if there's not any money left over at the end of each month, you're living paycheck to paycheck, the math, this is a math problem. The math just will not work in your favor. So then the question becomes are there debts that can be consolidated? Are there monthly payments that can be eliminated in order to create cash flow?
The first step is what kind of cash flow do you have? And you look at budget number one, and then you dig in deeper and you go, but did you really have to spend this? Or could we consolidate this? Or what if and you could find that cash flow. And then now the numbers start to look better.
Right. Yeah. And the thing is like you said, it's a degree of how much results can the strategy accomplish? Because if you say, I want to do the biweekly, like you just mentioned, that's going to take about, that's just a simple, like you said, an extra payment per year. That takes about 7 years off of a 30-year mortgage. Yep. So you're making progress. That's better than doing nothing. Or you could refinance to a 15-year mortgage and commit to the higher payment and have a shorter amortization schedule. That's better than a 30-year mortgage. But if you have the right cash flow characteristics, I mean, we see people and a lot of our clients, they pay off their home, and we talk about an average of 5 to 7 years.
Wow.
But we see people that pay off less than 5, and our goal is to get everybody to 10 years or less with our strategy, because we don't want it to be just a little bit better than what they could do somewhere else. We want it to be the best option that they have available with their current situation.
So going from shaving off 7 years at the end and paying that 30-year loan off in 23 years, which is great to show someone with the thousands of dollars that it saves. But you know what that means? You've stayed in the house for 23 years, and that's unlikely.
Right.
So what you're saying is, what if you can accelerate it so fast that you're not saving 5 to 7 years, you're paying the thing off in 5 to 7 years?
Correct. And then if you decide that you're going to, hey, now I can afford a bigger house, or I need to relocate for a job and I'm going to go buy a new house. Now you're in a situation where you have a lot of walkaway equity when you sell that property, so that you've got the money for a big down payment, or you could use a home equity line of credit to purchase the new home. And that way you now have the tool to eliminate whatever debt you put on to the next house. Yeah. So it's always about debt elimination.
And properly placing the funds that you have to best serve your financial future.
Correct.
Because is it better sitting in your savings account at 0.1%?
Right. Yep. And that's exactly it. Would you rather give the bank a free loan tonight at 0.1%, or would you rather avoid interest at 4.5% on your mortgage?
Or more.
Which is a guaranteed return.
Yeah.
Which also, remember, what a lot of people forget is that you pay $1 of interest with $1 that's been taxed. Yeah. So you had to go to work, earn the $1, get taxed on the $1, bring home that net $1, and then hand it over as an interest payment. So every $1 that you could avoid unnecessarily handing over as an interest payment is a victory, because that's $1 that could go to principal and help you avoid additional interest that would be accrued.
That's a misconception.
It's about changing your cash. It's about telling the bank, no more free loans. You can get a free loan from my neighbor, but you're not going to get a free loan from me.
I've heard it said in years past, like, I don't want to pay off my mortgage or pay extra on my mortgage because I get that tax break.
Yep.
But it's exactly like what you just said. If you pay that $1,000 to get, in your monthly payment, and you get, I don't know, $200 of a tax break, why not just not pay the $1,000 in the first place?
Right.
And there you have it. So it's perspective.
It's really amazing at how many people are so ingrained on, I can't lose my tax deduction. I no way. I can't even consider this.
Yeah.
I would never, I got to have that tax deduction. Well, you know what? I would much rather have my entire $1 that I work for than a percentage of $1.
Yep.
For a tax deduction.
Yep. Exactly. It's all a matter of perspective. So that sounds so neat, David. And I know that a lot of people would want to see like some specifics and calculations and estimates and what would it look like for me. So if someone is interested in learning more and reaching out and connecting with you, how can they best do that?
Right. So the best way to start would be is go to acceleratedbanking.com. And there we have a calculator that will allow you to look at your budget and start putting in some numbers and just getting an idea of what your cash flow would look like as far as potential results. And then from there, what we do is we have a free live online webinar that we do that gives you some more background and some more in-depth information about our strategies, because we do teach multiple cash flow strategies, because there's more than one way to use these HELOCs and lines of credit in order to get to the finish line and achieve results. So we would encourage you to go through your budget, use the calculator, start playing with that and seeing what kind of potential results you see, watch our webinar. And then from there, we offer a free consultation. And the purpose of that consultation is to answer questions, go back and go to that calculator and make sure we're using the right income, the right expenses, so that we can, see and set the expectations of what type of results could be accomplished. And then from there, we're really looking to answer the two big questions. And that is, number one, can you use our strategy? Do you qualify to get the right line of credit, to have the right tool that's needed to use the strategy? And then number two, are your results good enough that this is something that would make sense for you? And unfortunately, it's not going to make sense for everybody, like we talked about, the living paycheck to paycheck situation. But this is something that people need to know. This is something they need to research, because even if it's not today, let's just say we do a consultation today, they've gone through their budget, they speak with one of our consultants, and we tell them, you know what? I just don't think you're quite ready. The results there's some good results here, but it's just not good enough that I would recommend that you do this. But let me give you a couple tips. Hey, if you can get rid of this car payment over the next, 12 to 18 months, or you could do this, or you could do that, come back to us in a couple of years. Know this is out there. Know this is something to be working towards. And even if they come back 2 years from now, and 2 years from now, we can take them from 28 years to 10 or less, it's a victory. So life is about timing. Just because it may not, for some people, it might be absolutely, I'm ready. This is awesome today. Let's go. And there may be some other people that we say, you know what, you're just not ready. And we wouldn't want you to do this. We wouldn't allow you to do this because we have to get certain results before we would recommend the strategy, because we're not going to recommend it for everybody. But it's still a victory. So life is about timing.
Mm-hmm. I love it. Well, David, thank you so much for coming on today. It was a real pleasure talking with you.
My pleasure. I appreciate you having me.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneursradio.com.